Good evening, ladies and gentlemen. A very warm welcome to the Q2 and H1 FY'25 earnings call of Hinduja Global Solutions Limited. From the senior management, we have with us today Mr. Partha Desarkar, Executive Director and Group CEO, HGS, Mr. Winsley Fernandez, Whole-Time Director, HGS, and Head of Digital Media Business, Mr. Srinivas Palakodetti, Global CFO, HGS, and Mr. Amar Chintopant, Head of Finance, HGS Media. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Darshan Mankat from Adfactors PR. Thank you, and over to you, sir.
Thank you, Dorville. Good evening, everyone. Welcome you to the earnings call of Hinduja Global Solutions Limited for the second quarter and half year ended September 30, 2024. Before we begin the earnings call, I would like to mention that some of the statements made during today's call might be forward-looking in nature, and hence it may involve risk and uncertainties, including those related to the future financial and operating performance of the company. Please bear with us if there is a call drop during the course of the conference call. We would ensure the call is reconnected the soonest. I would now hand over the call to Partha sir for opening remarks. Over to you, sir.
Thank you, and very good evening to all of you. Before I start, I want to do an audio check. Am I audible?
Sir, you are loud and clear, sir. Thank you.
Perfect. Thank you so much for confirming that. So, ladies and gentlemen, it's a pleasure to be with you again for our earnings conference call for quarter two. There is a presentation out there on our website which we will refer to as we speak during our conference call. So, there is the usual safety statement about the future-looking statements that we will make. And after that, we'll get into our introductory slide, which is slide 4, which talks about the company at a glance. We are a global leader in optimizing customer experience, digital transformation, business process management, and digital media ecosystem. So there are lots of stats out there, people who have known us for a while. I'm not going to go through all the details out here. Suffice to say that we have 3 very strong businesses that we manage. I'll go to slide 5, which talks about the financial performance. Quarter 2 FY'25, our total income stood at rupees 1,207.6 crores. There's approximately 144.4 million. Our operating revenues were at 1,087.2 crores, about rupees 130 million. And our total EBITDA was rupees 154.8 crores, which is $18.5 million. EBITDA margins were at 12.8%. If you take the full YTD for the first half of the year, then the total income stood at rupees 2,426.2 crores. That is rupees 290.2 million. Our operating revenue was at rupees 2,179.1 crore, which is 260.7 million. And the total EBITDA was 298.3 crores, which is $35.7 million. EBITDA margins were at 12.3%. Key highlights that I'd like to call out, I'm on slide 6 now. We continue to see challenges from a revenue growth and a profitability because revenue growth has been muted. There are macroeconomic pressures, there are election uncertainties, delays in decision-making on awarding contracts, and drop in revenues from the UK business. Hopefully, with 2 of the large elections now over and a change of government now firmly in place, we will see clarity on direction, and therefore decision-making will become faster in the second half of the year. Our engagement with existing clients and the pipeline is actually quite healthy. We've signed 2 new contracts in North America with core technology services. So this is a point that I'd like to call out, that our technology services revenues are actually starting to do very, very well. You know that we have been in our journey to increase the digital component of our revenues, and I am happy to state that the two wins that we have are significantly core technology driven. Similarly, our Agent X, which is our AI-driven platform for customer experience transformation, that has won for the UK G-Cloud framework submission. That means the entire UK public sector can use G-Cloud for their services. So that's a big win for us. It almost opens up the market for technology services for us, consisting of 24 large UK public sector and 317 provincial government services. Very excited with this win. This happened early in October, November. And though we are yet to pick up revenues from this particular win, it qualifies us for bidding for the UK public sector. Our Australian business, HGS OSS, is seeing strong growth, witnessing offshoring trend to India by our Australian clients as well. Near geographies and Colombia and South Africa are tracking well, with promising pipeline for South Africa. Cybersecurity services, we've just entered into cybersecurity services with 7 new solution offerings. These are all AI-led, and that's the new thing about our services. Cybersecurity, everyone has a solution. We have an AI-powered solution. As I mentioned, in the UK public sector, Agent X is our big differentiator in winning new business with clients. It has been deployed with 16 clients across Canada, US, and Jamaica. And as we move into more technology-driven services, we are focusing on skills training for employees with an emphasis on digital. I'll move to the next slide, which gives you a snapshot of our Cape Town operations. So you will see the building on the top right. It is a campus on Woodstock in Cape Town. It is a site for the famous Treaty Tree, which is well known for its association with Dr. Mandela. South Africa's business case is that it provides about a 40 to 60% savings per FTE. Today we have about 136 seats that have been built up. But there are 4 floors. If and when demand picks up, we can quickly add floors and seats. We support 4 languages: English, German, French, and Dutch. Slide 8, you would have seen some publicity around our AI hub launch in Philippines. It is a state-of-the-art facility where we are experimenting with our AI service offerings. It is an interactive space where clients, partners, and employees can leverage advanced technologies of automation, analytics, and AI. We have a virtual reality, visual AI, and speech AI, all these technologies on display to showcase to our clients what we can do for them. So very excited with that. The most important recognition that one can talk about is the recognition that we've got from ISG, Provider Lens, rating Agent X as a leader's quadrant for intelligent agent experience and intelligent CX, AI, and analytics. You'll see that in slide 9. We are on the leaders quadrant in the top right hand. So our strategy focus continues to remain the same. We are vertical specific business and we are driving point solution towards end. Lean ops with intelligent automation, cost-effective clouds, experts on demand. Leaning into the potential of applied AI, most of our AI solutions are actually catered to client-specific business environment. Our AI Ignite, powered by a partner ecosystem, Agent X, which is now being customized for verticals that we are servicing, and the dedicated AI lab. I talked about talent management. As we steer the company into more and more digital frontiers, we are going through a massive reskilling exercise for our employees across Colombia, South Africa, Philippines, and India to train them on AI and technology skills. The last slide captures what we're talking about of bringing digital and traditional business together in the intersection of these two circles, which we are calling digital operations, which is AI-driven process management, process improvement, unattended customer service using conversational bots or interactive voice agents, attended customer service where the human is in the loop and therefore is continuously watching transactions that transactional IVAs driven by AI are continuing to have, and AI ops, which is data tagging, labeling. So this is the middle part of the intersection of our CX business and our digital business, whereas on the two extremes, you will have a conventional digital business, which is app development, maintenance, cloud, systems integration, etc., and the traditional CX, which is contact center with heavy workforce deployment, non-power driven back office, and technology seen as a job queue. So that is the end of my section of the presentation. I will hand it over to my peer, Vince, to take you through the digital media business update. Vince, over to you.
Thank you, Partho. Thank you, and good evening, everyone. And again, welcome to the call on the Q2 earnings of FY’25 and H1 as well. I'm going straight to slide 13. I hope everyone can hear me. Darshan, can you all confirm if my audio is through? I'm assuming it's clear.
So this is the moderator.
You
are loud and clear, sir.
Great. Thank you. I'm going straight to slide 13. I normally don't dwell too much on industry and environment, but this time I thought it's important because I'm sure a lot of you have been reading in the press and watching on television that there's this huge, exciting opportunity around the corner called broadband over satellite, or basically receiving internet from space, from a satellite. And full complete kudos to the government of India to push this actively, and effectively what it will do is it will provide connectivity to underserved and rural markets in the country. So what's broadband over satellite? Just to kind of dumb it down, and just to let you know, it's like imagine a tiny little dish on your rooftop, or even on your balcony, or even on top of your car. And there are satellites overhead which provide you broadband. So effectively, you're not connected through any wire, you're not connected through any medium. There's just a little satellite dish connecting to your device in your home, where you can receive broadband or you can receive internet connectivity. So this is a great model for the future. The reason why I chose to dwell on it is because if you'll recall, a couple of quarters ago, even over a year ago, One OTT Entertainment Limited, our broadband vertical, has been working on this. We have conducted, and I shared this in our investor calls as well, we have conducted tests in places like Tawang in Arunachal Pradesh, in Pulwama in Jammu and Kashmir, where we actually tested using this technology in terms of how it could bring education to remote parts of the country and bring infotainment. And if you look at this slide, and this is all thanks to news that is available in the marketplace, the best part about it is that suddenly access to education, healthcare, the public services of the government, e-commerce, suddenly becomes available everywhere, right, all across the country. And your company, that is One OTT Internet Limited, and the fact that we've got this amazing, through Next Digital, we're already connected in about 65% of rural India. We're really excited about the opportunity this provides for us. This is a sea change, and for us is probably the next big thing that will happen as we look to obviously partner or become a service provider to the large global players who are looking at this space. So stay posted for more news on this subject. Going to slide 14, I'd shared in the last quarter that there were a couple of initiatives that we had rolled out. I thought it was important to update all of you with the progress on that. If you look at One Business was essentially a product that we've rolled out through a proof of concept in parts of Mumbai in August. And the idea was, listen, we're sitting on so much of connectivity. How can we leverage it to offer our existing network to offer commercial broadband, mainly to the MSME and the SOHO segments. SOHO segments is basically the small office, home office. You're talking about lawyers, doctors, chartered accountants, designers, people working from home. And we ran this proof of concept, and we've been able to successfully carry out. We signed on some very, very nice clients in the last quarter itself, right from Kalyan Jewelers to the Prestige Group. And the POC has been successfully completed, and we're looking to roll it out across key markets. Essentially, again, we're providing quality broadband, quality connectivity to markets across MTN. And then as things kind of pan out, we'll look to expand it across to the rest of India. I also shared with you that there would be effectively two offerings. One would be the simple Business Connect offering, and there would be a Business Connect Pro. So this is ILL or Internet Lease Line. It's a dedicated connection to customers and with much higher SLAs and a dedicated customer care team. So that is on one business. One 7-star, as I shared with you, was the relationship we forged early this year, and the strategy was effectively to work with a strong partner and grow the business in certain key markets. We, as you know, took on a majority acquisition of leading Mumbai-based ISP 7Stars broadband business, and this has been an exceptional time for us. We've rebranded the business as One 7Star. So if you see the graphic on your screen on slide 14, the 7-Star Digital is now One 7Star, and it's been doing very well. I thought it pertinent, again, just to keep you all posted. And in fact, slide 15, if you'll go to slide 15, it's the branding and communications that we've rolled out in quarter two mainly, rebranding it for not just existing customers, but also the pitch to new customers. So we've come out with graphics all over, hoardings, bus stops, T-shirts for the teams, new portal, new website. And we hope any of you who is a customer of 7-Star in the past is now enjoying the One 7-Star experience. And we believe that this is another very strong activity that we embarked upon, and we plan to see it grow significantly as we go forward. In terms of where we are, this slide 16 is by far a very critical one, and I wanted to share it with you because I distinctly recall a question at the end of the Q4 analyst call where when we presented growth, well, we did over 28% last year, if you recall, in terms of subscriber base. And I'd categorically mentioned that our focus this year would be on improving profitability and moving to a strong, profitable base. And if you look at this graphic, if you look at the graphic on the left, we are focused on churning low-yield customers where we really weren't able to make any money. These were low-revenue customers. And instead of that, we focused on improving the quality of service and therefore driving the broadband ARPUs, or average revenue per user. So while we're seeing a trend across where revenues, ARPUs are either going down or remaining flat, we're quite happy that we've been able to grow from 174 rupees ARPU last year in Q2 to 189. I think the more important thing is that, again, which I had mentioned at the end of the Q4, at the end of FY'24 analysis, is that our focus would be on ensuring our mix, our revenue mix, or our product mix would be sufficiently diversified so as to not just reduce the dependency on the retail segment, which, as you know, would have ARPUs that would face challenges going forward, but more importantly would cater to a diversified set of customers which have greater duration of longevity and greater ARPUs as well. And if you look at the pie chart there, we've been able to achieve that in H1 of this year, where today 10% of our top line for H1 comes from our enterprise segment. That is very good, and we look to expand that even as we look to expand the pie. And the new managed service model, which again I'd mentioned in the last quarter presentation, that we were looking through a focused alliance with triple players in alliance. It already accounts for around 5% of the top line, not just triple play, but other partners as well. And we believe that this is the future going forward. Strong collaboration, leveraging our expertise in technology, leveraging our expertise in network, having the best people on board, and being able to support smaller ISPs in their growth story, managing their businesses for them, and obviously a win-win situation for the managed service partner as well as for our company. And that is also a factor in digital television. We've continued to improve our yield. There's been a slew of measures. If you look at the graph on the right-hand side, everywhere we're promoting our mixed product or our integrated product, which is digital television plus broadband plus OTT. So overall, our focus is quality revenue customers across DTV and broadband. We know that there are challenges in the market, challenges in the industry, but I think what always has kept the entire Hinduja Global Solutions apart from the rest is our ability to innovate and leverage technology, for tomorrow. So I think we've been able to do that pretty well. It's undoubtedly an uphill task, but we'll keep on pegging away at that. With that, I think I'm done at the end of my presentation, and that was slide 16. And I'm now going to hand over to Pala, Srinivas Palakodetti, who's our global CFO. Thank you all for listening patiently. Much appreciated. Pala, over to you.
Thank you, Vince. Good afternoon, everyone. Thank you for joining us on this Q2 earnings call. I hope my voice is clear. And
loud and clear. Yeah, Pala.
Thank you, Vince.
Loud and clear. Okay.
I'm on slide 18. This is the revenues performance for the quarter ended September 24. So on a year-on-year basis, there is a drop in revenues by roughly about 8%. The drop in revenue on the BPM side is about 13%. And on the media side, the revenues are up by about 10%, which is leading to the overall drop of 8%. And this drop in revenues is primarily due to reduction in revenues from our UK business, again, primarily from the UK sector. So for the first half for the quarter ended, actually for Q1 and Q2 of the current year, the BPM business accounts for around 71 to 72%, and the media business is about 28%. And compared to the same period last year, it was about 78% was coming from the BPM business, and about 22% was coming from the media business. On the margin side, our EBITDA margins have shown an improvement on a sequential basis, up from 11.8% to 12.8%, but lower than where we were a year ago, where the margins were about 15.9%. One thing to call out, in case between Q1 and Q2 of the current year, there is a decline in other income. While that is primarily because of the exchange rate fluctuations, in Q1 we had an FX gain of about 8.3 crores, and in Q2 that became a loss of 8.9 crores. So on the other income side alone, there is a swing of about 17.2 crores, primarily on the account of the FX variation. And this is primarily happening because of the, as a global company, our revenues costs are accounted into multiple currencies. And as you know, FX movements have been pretty volatile, not just between USD and INR. It's also being volatile between USD and GBP as well as USD and GMT. Practically all our currencies have shown volatility. Moving on to the next slide. On a half-yearly basis, our revenues are down by about 5.8%. And at the PAT and at the EBITDA margin, we are down from about 15.6% to 12.3%. PAT for the first half of the year, including profits from the discontinued operations, came in at about 111 crores, substantially higher than what we had at 35.1 crores for the first half of the previous financial year. Moving on to slide 20, this is on the balance sheet. Our balance sheet continues to remain strong. Our net worth as of September is over 7,828 crores. There is an increase in the DSO days between March 24, which was at 62 days, to 65 days at September 24. Clearly, there is seasonality. You can see what happened last year from September 23 Q2 FY'25, where it was 67 days. It has come down to 62 days. So we have no concerns on our receivables. All our clients are well established and strong customers who pay us. The other thing to call out is on the debt side. Between March of 24, when we had total debt of 1,306 crores, that debt has reduced by 49 crores to about 1,257 crores as of 30th of September. So we have been able to reduce our total debt during the current first half of the financial year. Moving on to slide 22. As I said, this is on the cash flow side. Key thing to call out is during the first half of the year, our capex stands at close to 66 crores, which is roughly about 5 crores lower than the same period last year. So we are being prudent about our capex, and also this mix is being determined by the type of business which we are doing. Only other thing to call out is we had some payments to be made for the TechLink acquisition, which continues to perform well. So there were some earn-out payments, and during the year we paid out roughly about 129.5 crores towards the TechLink acquisition. Moving on to slide 22. As I said, our balance sheet is strong. We have shareholder funds of about 7,083 crores, and our total net cash and treasury surplus, which is total cash and treasury surplus net of debt, that stands at 5,090 crores. And if you see between March and September, there is an increase of about 77 crores on a net treasury and cash surplus, being driven by reduction in debt as well as increase in the overall gross and treasury and cash surpluses. So we have a strong position on the balance sheet side. Moving to slide 23, this is on the revenue split. Our CX services account for about 57%, and our digital and media business accounts for 43% of the revenues. Within this 43%, so about 21% of the total revenues come from the digital services, what Partha referred to in his slide of digital business, as well as from the digital operation business. The CX services share has remained fairly constant in the range of 57% between Q1 of this year and Q2 of this year, though the digital revenues have shown a slight increase of the total revenue. Moving on to slide 24. This is the revenue by origination and by delivery. You would see that the UK business, from an origination perspective, UK business is around 12%. This has shown a decline from what it was in the earlier periods for reasons you mentioned early in our earnings calls. We had a lot of revenues coming in from related to COVID, and with COVID behind us, some of those revenues have also dropped, have tapered off and dropped. So the share of UK revenues has come down. The India revenues of 36% comprise the media business, the HRO business, and we do have some clients on the digital side who are from India, primarily subsidiaries of clients for whom we do work overseas. From a delivery point of view, India accounts for about 40%, US is about 23%, and Canada and UK at 13% and 10%. Philippines comes in at 12%. We expect, as we grow, to have, Partha mentioned South Africa. We do expect that to grow going forward, looking at the fact that operations have started in the current quarter and the pipeline looks promising. Moving to the next slide, this is revenue by vertical. The tech and media and telecom sector, that has not changed. That's been at the range of 55% between Q1 and Q2 of this year. As far as the public sector is concerned, this clearly has shown a dip. It was in the range of about 12% earlier. That has come down to about 8%. As I mentioned, this is primarily from the UK sector, UK business, where revenues have dropped from quite a few of the public sector clients, primarily on the healthcare side, related to COVID. BFSI has shown an increase and stands at 16%. Consumer and retail have also shown an increase at 13%. Some increase in the others. So that's the broad breakup in terms of our total revenue split for the quarter. Moving on to slide 26, this is the client concentration. The top customer accounts for about 10.6%. This is from the BPM business. Top 5 account for about 24%, and the top 10 customers account for about 32%. These all come from the BPM business. A lot of the digital business, the media business, clients are from the retail side. But we do expect that to change, as Vince mentioned, that we are going to focus more on the corporate as well as the small office businesses, semi-corporates for the broadband business. On the DSO side, there is, as I said, an increase between March 24 to September 24, as well as from June 24 to June 25. But as I mentioned in the earlier slide, this stood at about 67 in September 23. That came down to 62 days in March 24, and it's come down to 65 as of September 24. So roughly a two DSO day reduction between September 24 and 25. And more importantly, as I mentioned, that we have a strong client base and who are financially strong, and so we have no discomfort or any concerns on the receivable side. This is pretty much my last slide. So I would now like to open the Q&A session, and also back to Darshan for moderating the Q&A session. Thank you, everyone, for listening to me.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Dheeraj Kumar, an individual investor. Please go ahead.
Thank you for taking my question. I would like to know the current revenue contribution from the cybersecurity services and One Business, One Stop, and what is the contribution that we are looking forward in maybe the coming 2 or 3 years?
Bala, you want to talk about the cybersecurity aspect?
Thank you for your question. Cybersecurity is something which we have started only in the current financial year. So revenues at this stage are not, in the current quarter, are not significant. But this is an area which looks promising, and we expect that to grow going forward. It may take a year or two to build up some scale, but this is an area of large growth potential going forward. Vince, you want to take the one about
sure. To understand the precise number, is it 1 crore, 10 crore? Do you have any precise number for cybersecurity, even if it's not significant?
I don't have it offhand, to be honest. I need to check and I'll have to come back.
Okay, thank you.
Yeah. So, sir,
one business, one star?
Yeah. So, sir, 7star is actually more a joint venture where they had an existing business itself. The idea of strategically partnering with them is not so much financial, but it's strategic in being able to expand in markets. So rather than looking at it from a revenue perspective, we're looking at it from a reduced cost of acquisition. So my cost of acquisition, if it is X in parts of Western Mumbai, it reduces significantly by about 20 to 25%. That's how 7star works. On one business, your question is absolutely valid. It's a new product that has been rolled out. The ARPUs for such a business, I can share with you, the ARPUs are closer to about 10,000 rupees quite easily for a link. What will be the quantum of value? We've only completed a POC which has given us about 17 to 24 odd links. We're just rolling it across Mumbai in the first phase, and then Mumbai, Thane, Navi Mumbai, and then taking it to other cities. So I think by the end of Q4, we will see traction from Mumbai, Thane, Navi Mumbai, and then onwards to the other markets.
And what is the contribution that we are looking forward, maybe in the coming 3 years?
I'll tell you, we just did a POC, right, in August, sir, right? It was a 3-month POC, which was August, September, October. So we're still in the process of firming up a business plan. But as I mentioned to you, and if you look at the pie chart, our idea was more to ensure that our dependence on the retail sector reduces. To what quantum, that is a bit of a difficult thing to mention right now. But I can promise you this, that we'll definitely be in a position to give you a much better sense once it's commercially rolled out in towards the end of Q3. So by Q4, we'll be able to give you actual numbers, sir.
Okay, understand. Fair enough. The reason I'm asking this question because since the past 12 quarters, the company's earnings have remained stagnant, almost at the same level, and it's reflecting in the share price. Our share price is 3-year low, and we would like to know, if the company is working on anything new, which could increase revenue in future, and thus also lift it for all the investors.
Absolutely, sir.
And my last question regarding the financials, I see that we have borrowings of around 100 crore. But I don't see the reason why we have this debt when we have so much of cash flow in our balance sheet. The interest that we are paying is reflecting on the profit and loss statement, and there are many who just read the profit and loss statement and invest or sell the stock. So what is the reason behind this?
Let me take that. Good question. So the numbers that we have presenting are at a consolidated level, whether it is debt or net treasury cash. But a lot of the cash is come from the sale of the healthcare business, and that money is outside India and earning reasonable returns from a dollar return perspective. Well, technically, you could bring in money into India, and bulk of the money in India has been used for buyback, transaction cost, other growth initiatives. But if you bring the money back to India, you end up having a large tax in the form of tax on dividends. And so that's one of the reasons coming in the way of bringing all the money back to India. There would be a lot of tax inefficiencies which would come in.
Yeah, totally fair. I think that's a good way to look at it. And how are we going to, what are the plans to use that money? Because it's been a long time after the sale of the business, and are we planning any acquisitions, or are we planning any expansion, or will it just stay invested and we will only gain the interest on it?
No, so good question. So if you go back to what we have done, we did soon after the sale of the healthcare business, we acquired a business called Diversify. Then we acquired a business called TechLink in USA. That acquisition happened in the it happened in end February of 2023. So currently we continue to look for opportunities for growth. It could be, like we started operations in Colombia and South Africa, or it could be through acquisition. So we continue to look for acquisitions which fit what we want to do, and more importantly, at valuations which make sense.
And these two acquisitions that we have done, are they in the same domain of providing IT or IT management services, or do they belong to a different business?
So the business TechLink, which we acquired, that's primarily into analytics, so which is part of our overall plans to grow the digital operations and the digital service. The other acquisition which we made is called Diversify. It is an Australian company. It is into the traditional offshoring and also a little bit of a niche business called micro-staffing. But more importantly, the primary rationale for doing that was to get access to the Australian market, because we were not present in Australia till that time. And what we are seeing now over a period of time is a lot of traction for the digital services, a lot of traction, opportunities coming up for catering to the Australian public sector, as well as for the traditional BPM business offshoring into India or Philippines. These things clearly take time, but we are pretty happy with the way both the acquisitions have shaped up so far.
Yeah, thank you. Thank you very much for your time and clarifying my questions, and good luck.
And thank you for very interesting questions.
Yeah, it's a pleasure.
Thank you. Ladies and gentlemen, to ask a question, you may please press star and 1. We have the next question from the line of Ranga Prasad, an individual investor. Please go ahead.
Good afternoon, everyone. I hope I'm audible. At the outset, let me say that I'm deeply concerned about the continuing losses of our media division, both on a quarter-to-quarter basis as well as on a year-by basis. I'm wondering if we have a roadmap as to by when we can expect this division to turn profitable, or at least where the losses can be stemmed. It has been reported in the media that Elon Musk's Starlink is also going to be coming to India to offer broadband on satellite. Would this significantly increase the competition to our broadband business? I have certain other questions, but first, if I could get some clarification on this.
Sure. Mr. Ranga Prasad, good evening, sir. Vinsley.
Good evening. Yeah.
I'll be absolutely... So first, let me start with your second question first. So as far as what you just mentioned about Starlink coming to India, there's also Amazon Kuiper who's looking at India. There's OneWeb through Airtel, and there is obviously GeoSCS, which is there. There'll be others also like Viasat and a couple of other players. I think what these companies need is they need a strong partner in the country to be able to support them. And I'm not talking about regulatory support. I'm talking about that besides regulatory, there are 4 key things that any player requires. The first is a good, strong knowledge of satellite. And as you know, we are the only HITS player in Asia, and therefore we have experience in satellite. The second parameter is being able to understand broadband, the packages of broadband. We are in ISP today, India's 4th largest private ISP in the country. Third thing is you would need to have significant penetration in rural India, because basically broadband over satellite or satellite internet is targeted greatly at markets which are underserved or unconnected. And as you know, sir, we are present in over 4,500 pin codes. 65% of our subscriber base comes from semi-urban, semi-rural and rural India, including places like the far northeastern reaches of India, Andaman and Nicobar Islands, where we have a strong presence, even Kargil, right? And we're very proud of our connectivity in all these places, Tawang and Arunachal Pradesh, Pulwama. So, and the fourth most important thing is an entire ecosystem of sales to installation, to service, to support. And today we have 10,000 franchisees across the country, which is about 40,000 feet on the street. We've got our own 1,300 strong tasked workforce. So with all those factors, we believe that we would be in the most suitable position to align with a suitor, obviously given certain preconditions, etc. But I think that what we have done on the terrestrial side and in terms of building a strong infrastructure network, services and platform and rural connect, I think we believe that we'll be a strong player in that, probably partnering with one of the big players, sir. So I hope that answers the second question, sir.
Certainly, yes.
Thank you, sir. So on your first question, as you know, this is a significantly challenging industry, and we keep on innovating virtually every year to be able to push things ahead. I think the entire industry faces challenges, is facing challenges, especially the digital distribution industry. We're the only independent platform left in the country, largest independent platform in terms of a multi-system operator with HITS. And we believe that this combination that we've built of leveraging our digital television business to grow our broadband will see green shoots, sir. That much I can assure you. We are facing challenges quarter on quarter, but if you look at the way we've changed the product mix ever since we've come out of the lockdown and consumer preferences have changed, we've not let that temper our growth. We've focused on growth. I mean, just if you look at the top line, sir, last year, at this time, last H1 of FY'24, we were clocking about, I think, 500 odd crores in H1. This year we've touched 608 crores in H1 itself, right? So that's a 22% growth. But your point is valid, sir. The focus is now strictly on profitability, and that is being harmonized through integrating broadband and the digital television in a much bigger way than probably we did earlier. And given the fact that we've been able to now deal with the onslaught of OTT, customers changing preferences, free digital television services, so we believe we're on the right track, sir.
See, this lack of profitability has been weighing very heavily on the share price. As you know, today the share price is about 630 or 640, vis-a-vis the book value of 1,680. That's a discount of over 60%. So clearly the market is very concerned about this lack of profitability. I'm just saying that.
No, sir, you're right.
Needs to be noted. Now, I have some questions on the financials, just more in the form of clarifications. One is the balance sheet shows a goodwill amount of 997 crores. Could you please tell me what it is? Because it's also been increasing. This quarter it has increased from 959 to 997 crores. And is there a plan to amortize this goodwill over a period of time? If so, over how many years?
Yeah, thank you. Good question, Mr. Prasad. Let me answer that. if you look at between March 24 and September 24, there is an increase. Primarily, there are two drivers. One is Vince talked about it, the 7-star acquisition which happened during the, I think it was in April. So that's the drive. There's some goodwill which got created. And rest is actually happening primarily on the account of FX variation. To go back to a slightly different perspective, these are all goodwill which has got created, primarily from the acquisitions which we have made, goodwill on consolidation. It could be TechLink, it could be Diversify, it could be the earlier acquisitions as well. And from an accounting standard point of view, these are to be tested for impairment. Otherwise, they remain constant on the balance sheet.
Okay. Now, fine. Could you give some clarification on your deferred tax assets? You are showing deferred tax assets of 240 crores and an additional income tax assets of 500 crores. What is the distinction between the two?
So some relate to taxes which we have paid and for which we are essentially waiting for the tax refunds, the pending clearances, and this is primarily overseas. Deferred tax is primarily on the, either out of losses which have incurred in the past on which there is certainty and we have created a deferred tax, or normal in terms of timing differences between time period to period. For instance, in a year, if you there are some payments due, you can claim a tax rebate only when they are paid rather than on an accrual basis. So those are the others which come from the deferred tax assets.
The next clarification is regarding comprehensive income. They are showing 93.75 crores in this quarter. Could you please throw some light on that? And how it will affect our future net profit? Will it actually have any impact on the profits to be reported in the subsequent quarters?
Operationally, no. This is purely from an accounting treatment. For instance, if I take a forward cover or any hedge, which is, and the hedges are still valid and have not been impaired, any mark-to-market on those hedges would go into the other comprehensive income. And they would come in only in an extreme case. For instance, something has happened and the hedges are ineffective, in which case it would hit your P&L. But normally there would not be any impact on your profit after tax because these are items which go straight to the balance sheet without touching your P&L.
Okay. The final question is regarding interest expense. I see that it's going up even though the revenue has been coming down, revenue from operations. Is there any particular reason why it's going up? Is it because of interest rate going up, or is it because the quantum of debt that we have taken has gone up?
So multiple things. So one, as I mentioned, between March and September in this year, this is actually reduced debt. But this interest expense is there are two broad drivers. One is any loans which you have taken on which you have to pay interest. The second part comes from if you have taken any leases and then you have lease payments which include there is a component, it's a non-cash item, but it shows up as an interest cost and depreciation. And it also includes if I were to take a premise on lease under Ind AS 16, the rentals are ignored and then I have to replace it as if I have borrowed money to own that particular building, and then I have to charge interest and depreciation on that building even though I don't own that building. So the more than the cash interest part of it, it's the Ind AS 16 accounting part and the lease accounting part which is driving the increases in interest, especially if you see the difference between Q2 of FY'24 and Q2 of FY'25. where it has gone up from about 46 crores to 62 crores.
Okay. And finally, see, there's been a lot of negative publicity on the ongoing search and survey assessment going on. In fact, some media reports have said that the burden on the company can be as much as 2,500 crores. Now, the company has not given any clarification on that. So, is there any update on this ongoing search and survey assessment?
So, we have been making disclosures as required from quarter ending December 23. So, there was a search and survey which happened in November, December last year. And we have received, and again, this disclosure we have updated. If you see our publication page, there is a show cause notice which has been received. We are in the process of replying to the notice, and so that's where we are, sir.
Okay. So no definite figures have been mentioned.
We request you to please return to the queue if you have further questions. Thank you. We have the next question from the line of Anuj Panwar from Family Office. Please go ahead.
Yes, hi. Thank you for the opportunity. I just have two questions. So, in the BPO business, how do you see the growth in revenue and profitability going forward? And secondly, when are we planning to launch our broadband over satellite offering? Like, does it require further R&D? Just wanted to understand what's the status on that.
Pala, would you like to take the question on the BPM side first?
Yeah. So, thanks, Anuj. Good question. As I mentioned, we've had challenges primarily from the UK public sector part. So we are focusing on the private sector and more on the offshoring. So the South Africa Center was primarily set up to drive the higher margin profitable businesses. The other part is, as Partha mentioned, that we are also focusing on technology services. We assigned 2 contracts for clients in North America, where we are offering services beyond the traditional call center, BPO kind of a business. These will scale up. We expect them to scale up during the year, but the remaining part of the financial year. But the full impact will come only in FY'26, in the year starting April 25. And we believe these, since they have also a component of offshoring, that will help improve our margins in the longer run. Vinci, you want to take the question about broadband?
Anuj, just to tell you, I'm not sure if you would. So a couple of, I think it was probably a year ago, Anuj, we already have started providing broadband over satellite solutions using what is called a geostationary satellite, or GEO, right? Using the government INSAT series, and that is already running. We connect a couple of solar farms in the country. We've run it in Tawang and Arunachal. Those were tests that were done to see how good the quality would be in terms of education, in terms of using it for communication. We're already running the service, but it is running very small because it's a geostationary service. The big players that even Mr. Rangaprasad referred to are people like Amazon Kuiper and OneWeb from Airtel or Starlink, who are looking at LEO services or low Earth orbit satellites. That service, in my opinion, will probably come in next year. And the Telecom Regulatory Authority of India, which is the regulator for our industry, has in fact gone on records stating that they would come out with a pricing structure, etc., by December 15th this year. I'm talking about barely a few weeks away from here. So we believe by the end of of next year or so, we'll start seeing LEO tests happening in the country. We hope to see that. So we're happy to kind of bolt on at any point in time, Anuj. I hope that answers your question, Anuj.
Yeah, that answers my question. Thank you. That was helpful.
Thank you.
Thank you. Ladies and gentlemen, we will take that as our last question for today. I would now like to hand the conference over to Mr. Partha Desarkar for closing comments. Over to you, sir.
Partha, you're probably on mute. We can't hear you.
Yeah, can you hear me now?
There. Now we can hear you, Partha. Go on.
Yeah. Okay. All right. Ladies and gentlemen, thank you very much for listening to us in our Q2 earnings conference call, and we look forward to talking to you again in February when we bring up our Q3 numbers. All the best and good night.
Thank you. Thank
you, everyone.
Thank you, sir. Thank you all. On behalf of Hinduja Global Solutions Limited, that concludes this conference. Thank you all for joining us. You may now disconnect your lines.
Thank you. Thank you, everyone.
Thank you.